Hello again and welcome back. I'm Anthony Newgrosh, tax partner at BKL, and today I'm delighted to be joined by Sam Inkersol, one of our tax managers and the winner of Taxation's Rising Star of the Year Award 2022. Hi Sam.
Hi Tony.
Today we're here to talk about demergers. Sam, in overview, what are they and what do they entail?
So demergers are where we're looking to separate out two businesses which are in the same group, and it's generally to separate trading risk, and given the uncertain times at the minute, it's something that's on a lot of people's minds.
So from a tax perspective, Sam, what are the key considerations here?
So we really need to be thinking about stamp duty, income tax on the individuals receiving the shares possibly in a distribution, and also any gains that may arise in the group that's distributing the shares.
And how do we separate out the two parts of the group? What's the mechanism for that?
It really depends. There's two statutory ways of doing it, indirect or direct. We won't go into the detail, but basically what's happening is if you've got a holding company with two subsidiaries, you're looking to spin out one of the subsidiaries either to the shareholders directly or to a company which is owned 100% by those shareholders generally.
Now we can do this on a tax-free basis in many cases, but what are the main conditions under the statutory demerger rules?
We need to make sure that the companies are part of a 75% group. We also need to make sure that they're trading both the entities that are being left in the group but also the part that's being split out. And we also need to make sure that there's no consideration for a sale of the elements that are being split out. So it's quite difficult sometimes to get into those provisions.
It is complicated, but there is an advanced clearance mechanism, isn't there?
There is. You can seek clearance from HMRC. They should normally respond within 30 days. Sometimes it's slightly longer, sometimes it's slightly shorter, but generally it's around that amount of time.
Okay, now you talked about having to separate out trading companies and there couldn't be an offer on the table. What if there is an offer if we're looking to separate out investment activities? What are our alternatives there?
So you've got a couple of different routes we can take. You can either go down the liquidation demerger or you can go down a capital reduction demerger. Both are slightly more complicated. You either got to get a liquidator involved or you've got to start inserting holding companies and issuing a load of share capital to really give some value which you can then reduce to affect the demerger. So again, complicated. There's clearances you can also go for. So you can get some comfort from HMRC that you're not necessarily going to realise any tax charges where you don't necessarily need to.
Okay, and we've been talking about separating out ownership and mirroring the ownership.
Yeah.
There's a variation on the theme here, isn't there? We can also do a partition where
Absolutely.
You may take one part of the business, I may take the other. Any other thoughts on that?
The key point here is going to be the stamp duty. Because you're changing the shareholders, stamp duty is going to arise. So you've got to be quite careful if you've got high value businesses that are leaving the group, because obviously a higher number times 0.5% gives a relatively chunky stamp duty charge.
Okay, so that's how we can do it. I think the key message is plan in advance, seek advice, make sure you have time to obtain those HMRC clearances, and if you need to know further, Sam's your man.